When your organization is involved in a corporate transaction, it's common to use a financial model to prepare forecasts. Because large amounts of capital are at risk, and errors in the model could lead to wrong decisions, it's important to provide some level of assurance. This assurance can come from either a limited scope review or a full financial model audit. In this discussion, we're focusing on limited scope reviews. These reviews are suitable when there isn't enough time for a full audit or when a full audit isn't needed. It's important to understand that a limited review is not the same as an audit. An audit is more comprehensive and thorough. Limited scope reviews can be done by individuals or professional companies, but given their limited nature, it's usually not appropriate to provide a formal opinion letter. Instead, the reviewer usually reports a list of findings and discusses these with the model developer based on the agreed scope. It's essential to clearly communicate at the start and when reporting that this limited review does not guarantee the absence of errors beyond the agreed scope. This kind of review helps identify key issues quickly but doesn't offer the same level of certainty as a full audit. Managing a large and complex financial model can be tough, especially when time is limited. The methods we'll cover here can help reduce modeling risk quickly, though they can't eliminate it entirely. The key is focusing on what matters most and using creative testing approaches to get the most from your review time. Start by understanding the model's structure and flow through a conversation with the person who built it, and use tools like Spreadsheet Professional to assist the process. Agree upfront on the model's key outputs and decide which areas carry higher risk and which may be less critical or even ignorable. This helps form a risk-based testing plan tailored to the model. One important step is a design review to quickly assess if the model is fit for purpose and built well. If the design is flawed, the model will likely need significant work, so spotting issues early is crucial. Using spreadsheet audit tools can highlight design problems, such as excessive hard-coded numbers that don't update with assumptions, poor separation of inputs, calculations, and outputs, inconsistent formula copying, and embedded assumptions that aren't clearly distinguished from constants. These checks allow you to assign risk ratings and categorize the overall build quality, helping focus efforts effectively before moving on to other review areas. It's important to graph key sensitivity cases because visuals make it easier to spot patterns and unusual data points that might be missed in raw numbers. One common mistake to watch out for is failing to properly integrate and reconcile the profit and loss, balance sheet, and cash flow forecasts. These should all follow double-entry accounting principles, and the cash balance in the balance sheet must match the cash flow movements over the forecast period. To check this, you should review the financial statements code and verify that the cash balance comes directly from the cash flow. If it doesn't, that's a red flag for a fudged balance sheet. By varying the input assumptions and checking that the balance sheet still balances and that the cash balance aligns with the cash flow, any discrepancies found should be carefully investigated and explained. Flex testing is another useful method to assess if the model can handle stress scenarios by flexing key input drivers. Unlike sensitivity testing, you don't know the exact values at the time of review. Creating a clear audit trail from inputs to outputs can help spot errors and reduce the risk of black box models, achieved by freezing worksheets to compare variances between test cases and current results. Input assumptions should vary for each test, and the effects on calculations need to be checked for reasonable changes based on the scenario. Unexpected variances should trigger further examination. It's also helpful to compare these logic movements against a high-level analytical review of financial statements, shareholder returns, and lenders' ratios, which can reveal issues if expected conditions aren't met. Lastly, parallel or shadow modeling is a reperformance technique where parts of the model or the entire model are independently recreated. This approach is useful for auditing key risk areas or material outputs to ensure the original model's accuracy and reliability. When dealing with complex calculations, a practical approach is to rebuild the area under review and then compare the key results from this reperformance to those in the original model, assuming the same input assumptions. Any differences that emerge should be carefully examined and explained. For models relying heavily on macro code, it's important to distinguish between low-risk and high-risk macros. Low-risk macros tend to be simple, small, and lack program control structures, often just automating straightforward tasks. Higher-risk macros are more complex, larger, and include control structures like if-then or loops, and these often generate critical numbers. Reviewing these high-risk VBA macros involves several steps. First, understand the macro's intended purpose. Next, walk through the code and audit it against its documentation, then annotate the code every few lines to capture your interpretation, especially noting any discrepancies with the documented logic, which need further investigation. Finally, design test runs, execute the macro, and compare the results with test data to check accuracy, as reviewing the code alone might not be enough to guarantee reliability. While these methods can help reduce risks in financial forecast models, they cannot completely eliminate the possibility of errors.